This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss how artificial intelligence is affecting the stock market and what opportunities and risks investors need to be aware of. Now, you've likely heard of the group of stocks known as the Magnificent Seven, which includes Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. This group of stocks now makes up about 35% of the entire S&P 500 and are the largest companies in the world. While it's tempting to focus on these companies since they have performed well recently, investing for long-term goals requires a thoughtful approach to both growth and risk management. Over the next few minutes, we'll explore historical patterns of market concentration, examine current valuations, and discuss how to balance opportunities with concentration risk. First, you might think AI has little in common with railroads, but history shows that transformative technologies often follow similar patterns. In the 1860s, railroad stocks dominated American markets, much like technology stocks do today, creating market enthusiasm and rising valuations that would sound familiar to modern investors. This pattern has repeated many times across history. The dot-com boom of the 1990s provides perhaps the clearest recent example. Each of these waves followed a similar pattern of skepticism, rapid adoption, market enthusiasm, and eventual integration into the broader economy. Now, many dot-com companies did fail in the late 90s and early 2000s. But many others went on to become today's technology leaders. So what matters for long-term investors is less the specifics of each company and instead the impact that these new innovations have on the broader market. AI, for instance, is being adopted by many companies, and the hope is that this boosts productivity and efficiency over time. So while stock prices of individual companies may rise and fall quickly, it takes much longer for the full economy-wide effects to be felt. Next, it's important to focus not just on the AI story, but on the valuation levels that investors are paying for it. Today, the overall S&P 500 is trading at 22.5 times price-to-earnings ratio, a level that is approaching the all-time high of 24.5 times during the dot-com boom. This means investors are paying a premium that assumes these trends will continue at the same pace or better. The phrase priced to perfection is sometimes used to describe these types of high valuations. The question is not whether AI will matter, but whether these valuations are reasonable. This is especially true since investments in AI infrastructure are measured in the hundreds of billions of dollars. This exceeds the entire GDP of many countries. It has also driven the valuations of companies such as Microsoft and Nvidia to $4 trillion. Companies like these are sometimes known as hyperscalers since they are rapidly building the computing infrastructure needed to support AI applications. However, markets often overestimate the speed at which transformative technologies will generate profits. The 1990s offers a cautionary parallel. During that decade, some investors believed traditional valuation metrics no longer applied to internet companies. Of course, we all know how that ended. When reality did not meet expectations, the Nasdaq fell 78% from its peak. Finally, this leads us to concentration risk. Since the Magnificent Seven now represents such a large portion of major market indices, nearly all investors have these stocks in their portfolios. Allocating too much of a portfolio in just a few investments creates what is known as concentration risk, which is the opposite of diversification. Now, it may feel good as those concentrated stocks go up, but what happens if they underperform? The risk becomes more evident. The point is that financial success is not about picking just a few winning stocks, but maintaining an appropriate portfolio that is truly diversified, incorporating not just different asset classes, but also utilizing different approaches and disciplines, including buy and hold strategy with tactical strategies and alternative strategies. That's what we call multidimensional asset allocation. As I've said many times, it's not about predicting the future, it's about preparing for a range of possible outcomes for the future. Now, I hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our white paper. You can click the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.